Good morning, ladies and gentlemen. Selamat pagi, Malaysia. Sorry for the delay. As you know, Friday fever, sometimes traffic jams are massive in Kuala Lumpur city. And besides, we are in the right smack in the city. And sorry about that. Okay, let's begin. Caroline Gross, Deputy Dean, Faculty of Science, Agriculture, Business and Law. And she has been here for the past 6 weeks, and of course she is 6 weeks here and 6 weeks in Australia and things like that. So she has been fantastic, fabulous in helping to make sure that the delivery of the programs in Malaysia is done accordingly with the Australian system of education, which is moving fine. Thank you, Caroline. And also, I'd like to introduce Professor Alison Sluden from the Business School, and also Professor Jason West, the head of the Business School as well. He is fabulous as well as in background in finance and accounting basis. I'm sure the talk is going to be very, very interesting. So, on behalf of IEG Campus, we are the support center of UNE, and we are going to work together with UNE to take to the greater heights. Without much ado, I will welcome Professor Caroline Gross to take on.
Well, good morning, everyone. Thank you for coming today. So UNE has been operating with our IEG partners since December, and we have 360 students studying with us, and it really makes us realise how small our neighbourhood is, Asia and Australia, being so closely connected. And that, of course, makes both countries quite susceptible to global volatility. So it's a really topical talk we're going to hear about today from Jason in that regard, to do with business and global opportunities and resilience. But let me introduce you to Professor Jason West. In 2019, so just this year, he earned his PhD in mathematical finance from the University of Technology, Sydney in 2004 in the fields of options pricing and commodity price behaviour. He's worked in quantitative research and analysis in a number of institutions, including the Standard Chartered Bank in Singapore, the Commonwealth Bank in Sydney, Suncorp in Brisbane, as well as the Director of Fiscal Management in the Queensland Treasury in Brisbane. He also led the commodity research team at BHP Billiton from 2007 to 2011 in The Hague in the Netherlands, after which he was appointed as Associate Professor of Finance at Griffith University, which is Brisbane, then Bond University on the Gold Coast, and then more recently he was a Senior Research Fellow at the University of Queensland in Gatton and Brisbane. Jason has extensive publication record in agricultural economics, commodities, portfolio management and risk. He's published more than 50 peer-reviewed journal articles and 2 books since returning to academia in 2011. It's probably more than that now because you've had a few months since we wrote this. Jason has obtained competitive grant funding from ARC, which is our Australian Research Council. It's the most research facility, and the Queensland Department of Agriculture and Fisheries, and this is amounting to over 500 million Aussie dollars. He's also an Australian Office of Learning and Teaching Fellow, conducting research into interdisciplinary curriculum development for data science. Prior to his PhD studies, Jason spent 12 years in the Australian Navy as aviator on various warships. His other qualifications include an MBA in accounting from UNE, a Masters of Engineering from University of New South Wales, a Bachelor of Science in Mathematics from the ADF, the Australian Defence Force, and the University of New South Wales. He's a chartered public accountant. I must speak to you later, I've got a few issues in that area. A certified investment management analyst and a professional risk manager and a chartered secretary of the Governance Institute. So as you can see, he's very well credentialed to talk about taking advantage of economic downturns. Welcome, Jason. I'm looking forward to your talk. Thank you.
Thanks very much. Do I just need this, or do I need the microphone as well? Microphone as well. And look, thanks all for coming, for spending time out of your precious day on a Friday to come and listen to talk about recessions. It's usually something that people don't want to hear is what happens during recessions and what's it going to do to my business, what's going to do to my investments and my wealth and my family and so on, and my job prospects. But it is important to embrace this topic because it will occur, it will happen, it has happened, it will happen again multiple times throughout our lifetimes. So it's best to work out, well, what does that mean? What does it look like in the run-up to it? And what does it mean during and after, I guess? So that's what we're really interested in looking at today. So, look, recessions, it's a common topic. And the common topic, or the common question that everyone tends to ask is, well, when's the next recession? And if you read the US press at the moment, there is a lot of talk about, well, we're probably overdue for a recession. It's been 10 years since the last one. What's the next one going to look like? How's it going to manifest? And where is it going to take us? And what do we do during it? So these are the big questions. And everyone lives in fear of these recessions all the time. So it's important to address them up front, I think, and be as practical and pragmatic as we can in understanding what governs the cycle and so on. So this stems from some work I've done with Capital Partners, which is a group in the US, and some other investors in Australia, just looking at the characterisation of recessions and how they manifest and what occurs and what sort of indicators we can use to help us understand the dynamics of them and then work out, well, what do we do with our investments during that process? So I'll try and be as specific as I can and just focus on the investment aspects of this rather than the wider economic aspects, so we can get into those later. So I'm not a traditional economist, I'm a finance person, so unlike economists are pretty good at predicting recessions. I think economists have predicted, 10 out of the last 3 recessions, so they're very good at going, oh, it's coming up, oh, the next one's coming, and it never happens, and they'll always identify the next one and the next one. So, and the trouble, I guess the genuine trouble with recessions is you don't know that you're in one until after it's occurred. You don't really have the data on hand to see what's happening during the recession until, you look backwards and go, oh, right, we're in a recession. So that's the main problem. So the main questions tend to focus on what are the major determinants of trying to predict a recession. So let's look at those main indicators, and I'll try and drag out what those main indicators are so that we've got some idea of what we're dealing with. Then we want to work out, well, okay, if we know what the predictors are, what's the lead time between the predictor going south and then the recession actually occurring? So it'd be nice to work out, well, what's the lag involved in that? So if I see housing start to decline, then how long have I got before I know that I'm in the recession? So if we can predict that, then we can perhaps anticipate it and move our investments somewhere safer. We see a lot of clients in the investment clients really asking, well, will the next recession start this year? And so these are US-based clients that we did this work for, looking at, well, what's the prediction for a recession, in America for next year, for the 2020 is their kind of their rough concern. And I guess that's the key thing is at the moment we're saying no, we don't think that the next recession is this year or next year, but there are some indications that it's on the way. And then the fourth question, I guess, is will the next recession be the same as the last recession all over again? And the thing with recessions is none of them are the same. They're all fairly different in the way they manifest, the way they act, the way they operate, and how the economic fundamentals change during it. It's a little bit tough to kind of to put a badge or a brand on every particular recession. So they're the 4 things we're genuinely interested in. And if I can give you some pointers or some tips into the things that we think about when we're advising clients, and these clients are, billion-dollar clients who've got a lot of money to stick somewhere, and they're worried about where that money is going to go, what will happen to it during that recession, then how can we, best advise them to protect that through that period. So, first of all, we tend to we just grab the brutal facts. It's always wise to just look at the facts, look at the data, and assess whether or not that's telling us anything in particular. So, first of all, the first question is, well, how old is the current expansion? So we haven't, and I guess I stress that this is a US-based focus, but we all do know that when the US sneezes, the rest of the world gets a cold. So anything that happens there tends to be a leading indicator elsewhere. Malaysia, Singapore, this region is a little bit different. Recessions don't happen in the same way, but I'll try and make some comparisons with the US as we go through the talk. And if you have any questions or interjections along the way, then please ask them. I'm happy for questions as we go. So the current expansion, we look at, say, measuring in terms of duration. The average duration. This graph is depicting, looking at all the data we have over the last 100 years or so, that the duration between recessions is about 61 months on average. So 5 years plus or minus, and we're looking at a current duration of recessions in excess, roughly 10, so it's twice as long. So you look at that and you think, okay, well, we're probably late for a recession based on the data. But if we measure this in terms of another metric, which is just looking at, well, what's the magnitude? So how far are we since the last peak, or since the prior peak? The average duration till the next recession is we go 123% from the previous peak to the next peak. So we double in value plus a bit, plus another 23%. We're only at about 119% since that previous peak. So that's tending to suggest that, okay, we're probably not overdue a recession based on the magnitude of the recent growth relative to the duration of the recent growth. Now, it's hard to test these things because we've only had, maybe 10 or 15 genuine recessions. That's not a statistically significant sample size to predict what's going to happen in the future, but, we've got some indication at least. So 119 versus 123, we're getting close, okay? There is some genuine concern that we're probably late for some sort of recession. So we all know that recessions occur for various reasons. And if this was the basic economy, I'm living in Malaysia, I consume stuff, I produce stuff when I go to work, I'm employed, I generate income, I want to buy imports, and then there's this foreign demand for the consumption of the things that we produce in Malaysia, okay? Semiconductors, cars, all those sorts of things that are built here. So this thing sort of sits in balance during the expansions until one of these things becomes, too significant. Either there's a massive, oversupply of employment, or there's a massive decrease in consumption. One of these things breaks generally. What happens, and the recession is then triggered by just one of those little manifestations after this thing is built up. So, I guess recessions aren't a bad thing in themselves. They're a bad thing in themselves, but they do get, recessions are very good at forcing the fat out of the system. So inefficient operators who are rent-seeking, who are generating returns in excess of what they're owed or what they're actually worth, we'll see them exit the industry pretty quickly during a recession. And that's their purpose, is to flush out the inefficient manufacturers, the inefficient methods of production and so on. Inefficient, costly employment practices, those sorts of things. Terrible industrial relations policy. Those sorts of things get flushed out during a recession, and then the economy resets so that this circle of consumption for a market-based economy is kept in balance. So that tends to be what happens. In terms of cycle dynamics, so this is something we looked at with capital partners, just trying to predict where everyone is in this business cycle. And so this is not, a real cycle. It's like a figment of our imagination of what happens during a business cycle, but we need some way of representing exactly what happens. And every country goes through these things, except maybe North Korea, which is always, flat perhaps, who knows. But generally, market-based economies tend to go through this cycle. And it appears that the countries that are sort of mid-cycle, where they're in full employment, wages are starting to accelerate, Profits are peaking. Inflation is starting to rise up again towards its target of about 2%. The countries that seem to be in that area are the Eurozone. Japan's probably, it's a tricky one, Japan, because they have funny dynamics. Germany, China is well down the path. And then we have what's known as late in this cycle is the UK and the US and Canada and Australia, New Zealand, and probably Malaysia and Singapore are in this area right about here. We all seem to be late in that cycle. We're seeing profit margins start to come in. We're seeing credit growth moderating, but banks are now starting to lower their cash rates. So they're easing off on monetary supply, trying to force money out into the system to get economic growth going again. But we are still seeing credit being a little bit tight because people are afraid to spend because the recession is coming. Why would I buy something now when I know in 6 months' time there's a recession around the corner and it's going to be cheaper potentially, so I'll hold off. And then that triggers the recession potentially because people aren't spending, they're waiting for the price to fall in 6 months' time. So that's the initiator. Central bank policy tends to tighten, but at the moment it's loosening, so it's a bit confused how that looks. We tend to see inflation starting to rise above target, but at the moment inflation's pretty dormant in most of these areas. Malaysia and Singapore inflation's going pretty well, I would think. Credit is readily available. House prices are rising. So once again, Malaysia and Singapore are bucking the trend a little bit there. But you are seeing profit margins contract here. And then there is this rising breadth of imbalances. You do see massive wealth differences. You do see current account and capital account deficits and surpluses start to expand and so on. So all these things start to, trigger. And we see it in the papers every day. A new thing is released, a new statistic is released, and you can see, okay, well, that's starting to increase. So we can see this recession starting to come. But the question is, when's it going to occur? When are we going to get into this actual point here? It seems that we've been in this world here for a couple of years, and we're not actually moving into that late part of the cycle. So that's the interesting part. And there are other countries that are way in at the other end of the cycle. So countries like India, some of the South American countries, Mexico, you would say, is down that end as well. So they're starting to see a ramp up in their economic activity, housing activity, and so on. So the world isn't all the same. It is all a little bit different, but that tends to be the general consensus at the moment. When are we going to get into this point here when the recession starts? So I'd like to just start to introduce some of these key indicators that you might be able to look out for to help us unpick exactly what's happening. So what are the warning signs? So generally, the key warning sign for a finance person is that the yield curve inverts, and I'll explain what that means in a moment. But generally, longer-term bond yields or longer-term interest rates tend to be much lower than short-term interest rates. And so the yield curve inverts, which is slightly unusual. It means that we're expecting long-term growth to be very low, long-term inflation to be very low, and much lower than it is today. So that's a key indicator, and it tends to be the best predictor of recessions above everything. And the average months until a recession occurs, when the yield curve inverts, is about a year and a quarter until it occurs. So the yield curve inverted in the US in March this year. So if you were going to gamble on this, you would say, okay, well, on average, middle of 2020, in the lead up to the next US election, that's about when the recession will occur. So what are the dynamics that will what will it look like then? The trouble is, you won't know you're in the recession until 6 months after it's passed. I'll show you why that is as well. Corporate profits tend to decline. Oh, sorry, yes, question?
Go back to the last slide.
Yep, sure. Oh, sorry, yes. So this just indicates the size of the country's GDP. The size of the circle indicates, the size of the country's GDP in trillions of US dollars. Yeah, it's just to say US is very big, UK is not, still big, still like $4 trillion. Yeah, no, that's fine. So Australia's GDP is about 1 trillion, so, like a little circle there. Malaysia and Singapore is about $500 billion or maybe 600 billion, somewhere around there. So a little bit smaller again. But still, significant, not bad, still there. So all we've done is just depict the larger economies here. The rest of us suffer when these guys suffer, obviously. So corporate profits, once again, corporate profits are a bit tricky because you're looking at an average over the whole corporate sector, and that's a bit tough because some corporates are doing really well. So the tech sector, you would say, is doing great. Manufacturing sector in the US, not so great. So you would look at those things and go, okay, well, what's the average? You know, there's a really large range in corporate profits between those. So this one's a little bit fuzzier. Unemployment is fairly a good indicator. So because the statistics are fairly well collated, well understood. So we know that, look, when unemployment rises, consumers immediately stop spending, okay? If one person in your household has lost their job, then spending comes right back. And that's often the trigger for many recessions. So when you see unemployment rise, the next recession is probably half a year away. The peak of the next recession is half a year away. Okay, so these are key indicators that economists and financiers look at all the time. And that's why they report them in the newspaper: yields, unemployment, housing starts, and other leading economic indicators, because they are the key thing that sort of triggers. And you were able to triangulate then. When you can see the yield curve, you know you've got 15 months. You see unemployment, you know you've got 6 months. You see housing starts, even sooner. So all of these things start to triangulate your reasoning to say, okay, there's a recession pending, so let's think about what that means for us going forward. Housing starts, once again, when they decline by at least 10% from the previous year, so this is the approval for new houses, then you know that a recession is fairly imminent, because you know, I guess the key driver for GDP growth in a country, one of them is housing. It's probably 30% of your GDP is embedded in housing and housing growth, so it's going to be a key indicator or key feature, the key element that drives that GDP down. And there are other leading economic indices. So one measure is to look at an aggregation of multiple leading economic indicators, which give you a broad spread across the economy, and there are a range of things. Some things come in, some things go out of those, so you do have to be careful with those things. But the key one is this, for me. It is always, not always, but generally infallible in predicting when a recession is occurring. So if this represents 3-month yields, so short-term yields at about 2 in the US, 2.2%, somewhere around there. They've been hovering around there for quite a while, and have been much lower than that prior to 2018. But longer-term yields, so the 10-year bond yield, you know, well above 2.5%, closer to 3%. That's now come in and has collapsed and is now inverted. So basically, there's no reason why I would buy a 10-year bond, because I can buy a 1-year bond and roll it over 10 times and probably outperform the 10-year bond, okay? So that's where investors are thinking now at the moment. If longer-term projections are low credibility, low stability, very uncertain, then no one's going to put their money in for long-term investment, okay? They're going to, you know, look for shorter-term investment. So the shorter-term investment drives interest rates up, which drives longer-term interest rates down, and those yields switch. And so generally during every recession we can see what the spread between those two looks like. So the spread being the difference between them. The spread there is 0. The spread here is 2.9 minus 2.3, so 0.6. So spread being 0.6, which is about there. So that's where we were a few months ago, and now we're starting to come in and the spread has declined. So the last time that happened was right before the GFC, when everyone had that old holy hell moment. We're in a bit of trouble here. That bank has collapsed and that one's collapsed. Investors have already foreseen this because share prices have declined. So I might take my money out of the 10-year bond and put it into the 3-month bond just in case I need it. And so that indicates, that triggers that yield curve switch. So a normal yield curve looks like that. A flat yield curve looks like that. An inverted yield curve looks like that. And inverted is generally bad. It means that short-term prospects are much, much better than long-term prospects. And we don't want that. We want long-term prospects to be better than short, if we can. If we look to, say, Singapore and Malaysia yield curves, so this represents the yield curve in Singapore. This is the short-term. Money market rates generally dominate the shorter term, so rolling monthly notes or, forward rate agreements. And then there's a bit of a decline out to the 2-year point. But generally, longer term, there is some expectations that longer term yields at 2.5% are a little bit better than 1.8% or so at the shorter end. However, you can see that 6 months ago, 1 month ago, and the other day, a week ago when I did this, the yield curve is starting to flatten, okay? And as it starts to flatten, the question is, will it invert? Will this kick up? As people look at this and they go, well, I'm starting, if I was going to stick some money in a 10-year bond out here, it's about the same as putting it in a 1-year bond. So I might just stick it in a 1-year bond instead. And that drives the demand for 1-year bonds up, which, drives yields up, and it drives the demand for 10-year bonds down. So you'll see this flip. And when it hits that point, then you're in not big trouble, but it's generally an indicator for recessionary conditions. Malaysia is looking much, much healthier, to be honest. I mean, yield curve has come down. It's looking flatter, but it has shifted down rather than tilting down, which is a better indicator or a better, prospect. It's clearly saying that credit is coming down. Credit is cheaper. Expectations of, future growth in Malaysia are looking good, so that's great. And the whole curve has shifted down, which is exactly what you would like to see. Only when this starts to anchor to that point and the rest of the curve starts to shift down do we start to get worried. So that's what I would be looking for if I was a Malaysian investor or looking for, to invest in Malaysia, borrowing Malaysian money to invest in Malaysia, then I would be looking at that kind of yield curve dynamic. Right, other things that are a leading indicator. Stocks tend to be a leading indicator. Investors aren't stupid. Investors pay investment banks and analysts a lot of money to predict cycles and see how things are progressing. So in the previous recessions, if we look at the average of all recessions in the past, we see that the markets peak roughly 8 months prior to the actual recession, when the economy itself reaches that a peak itself. So there's a leading indicator there saying, okay, well, when you see stocks to start to peak and then drop off, then you've got maybe 6 to 8 months before the recession actually starts to bite and occur. But once again, you won't know you're in this period until you're in it, right? Until you go, okay, geez, we're actually in a recession, and then we fall off a cliff, right? And that tends to be what happens. Now, these are genuine recessions where there's a decline in the peak of the market to the nadir of the lowest point of the market by 10% or so. You're looking for a substantial decline. That's a genuine recession in terms of the valuation in stocks. And the cycle tends to lag the equities market. But once again, I'll show you that this is not such a bad thing. You can take great advantage of this if you're an investor. Once we're in this recession, it does bounce back pretty quickly. Stocks tend to get rid of all the trash. The companies that need to collapse. They get washed out of the system. The inefficiencies get washed out. Companies sack the people they need to sack, tighten up their cost structures, tighten up the way they do business, and then we see a bounce back because investors, have renewed confidence in the way the companies are operating, and the economy as a whole starts to bounce back. So that tends to be the cycle of what we observe. So this is a graphical depiction of unemployment. So this is one of the other indicators that we looked at. So unemployment versus the cost of unemployment. So the light blue line is the unemployment rate, and it's measured on this axis, and the cost of the growth in employment, so how much it costs to pay those employees, is on this axis here in the dark blue. And so we see prior to every recession, there tends to be a massive gap between how much it costs to pay your workers and how many workers are not employed. So we see a really large gap followed by an immediate recession. Gap occurs here as well, but no recession. Gap occurs here, there was. So this was the recession in the late 90s, the one that we all had to have, where we see that employment conditions contract straight away. Unemployment goes, in the US, unemployment went from roughly 5% up to 7.5% within the space of a year and a half. And obviously tied with that, when you sack a whole bunch of workers, then the cost of hiring them is going to decline as well. Okay, so we see this massive shift, and these curves are going to be, by design, inversely correlated, just because that's the way that the things are structured. But we see once again, unemployment goes right down to really low unemployment. This is full employment almost in the US, and then we get to that point. The economy just can't handle that many workers. It's just a cost structure can't bear it, because it just doesn't. It just can't have all those there's going to be inefficiencies in employment conditions, and they can't all be employed. Not everyone can be employed. So we get this overburdensome cost structure in most companies, where we go, okay, we're actually not making enough money to hire all these people, and so we see immediate changes in the structure of that employment dynamic. And then same again, and here we are again, once again in the US, unemployment is almost at just above 1%, like it's tiny, and this is in terms of, I guess, employment has a tricky measure anyway, because there's employment and there's full employment, partial employment, and so on. But if we're just looking at a general indicator, we would say, given this gap between the amount it's costing us to hire all these workers and how many workers are employed, there tends to be another indicator that a recession is imminent. Okay, so another indicator is corporate debt. So this is where corporates are borrowing. If a corporate is comfortable with their future prospects, they'll borrow money because they're confident they can pay back the interest and the principal as and when it falls due. If you're not confident about that, then you tend to raise equity instead. You can take that. You can hear me okay? Okay, good. So with corporate debt, this is corporate debt. This is non-financial US corporate sector borrowing, so non-banks, just looking at the industrial sector in the US, and we see that it's currently at a record high. So we're looking at something like 45% of total GDP. So in the US, we're looking at $10 trillion worth of borrowing to finance their expansions, and that indicates that they're comfortable with future conditions. They can pay back their interest on those loans. So 1% interest on 5 trillion is a big number. The economy has to earn that just to stay afloat for these companies to exist. Companies, when they are comfortable with future conditions, borrow money. Companies that don't or aren't comfortable with future conditions will raise capital through the market. So if there's a share raising going on, company X wants to raise, I don't know, $1 billion worth of new shares, that's an indicator that it can't afford to pay back debt, okay? So it's raising more expensive capital, but it doesn't have to pay that back. So the banker does have to pay back, okay? So accessing debt is generally an indicator that companies foresee, future growth. Companies game this system though too, because they know that investors know that if they borrow money, then it'll make investors think that they're actually doing well. So you've got to be very careful about, if a company goes out and says, I'm going to go and borrow some money because our company's doing so well, investors will look at that and go, well, hang on, are you actually doing well, or are you just trying to fool us into thinking that you're doing well, so we'll buy your shares and boost your profits up. So that's the catch that's involved in here. So there's a bit of, gamesmanship that goes on there, trying to bluff each other. But generally, corporate debt, when it spikes to a particular point, is sometimes a leading indicator that a recession is imminent, and when it hits that peak, it will decline. So we're starting to see a bit of a decline there. This is a weaker indication of recessionary behaviour than anything else, but it is instructive. It's also cheaper. Yep.
Which means that the gearing will be higher.
Yeah.
Yeah. Will that lead to?
Yeah, that's a good question. So that's potentially a question. So if you're borrowing at like here, rates are 1% plus a spread depending on how risky you are. So maybe another 200 basis points. So 3.5% you're borrowing at. You think, well, okay, I'll borrow $1 billion, and that's only going to cost me, $35 million worth of interest this year. So yeah, I can take that on. But then you have to work out, well, can I afford $35 million worth of interest just to service the loan? What if interest rates go up to 4% or 5%? Can I afford the extra 10 or 15 million? So that's a good question, yeah. So when they take on additional leverage, yeah, that's the trade-off that they're thinking. Yes, sir?
Question. I'm just curious about the causality of the debt and the recession. Don't you think it's the other way around, that whenever the recession occurs, then the debt goes down?
The debt goes down, yeah, exactly. So that's a good point. And that's what this doesn't depict, is going, okay, well, during this recession here, how many companies actually folded and disappeared, and that debt then just disappeared with it, right? It just, yeah. So obviously the debt came down not because companies paid it back, but because it disappeared. Investors had to write it off. So it's a very good point.
So the graph doesn't really show causality of which causes what, right?
Yeah, that's
so
right.
So it may be misrepresentative of the
Yep.
of debt being an indicator of recession, right?
Yep, yeah, it's a very good point. It would probably be better on this graph to put interest rates where interest rates were as we go through time. Yep. So here interest rates, you know, were quite low. Again, times were booming, lots of credit available. And then they did spike as credits blew it. So the underlying interest rate stayed flat, but the riskiness of investments increased. And so when you're pricing a new debt deal, you go, okay, well, most companies will go, I'll take the government rate and add 2% to it, or 3%, or 4%, or 5%, depending on how risky the company is. So it's that spread is the thing that blows out. And so that's what governs that. Yeah, but you're absolutely right. I mean, after the 87 crash, I think most of that debt just actually, you know, got hidden under the mattress. It didn't decline. People didn't pay it back. It just disappeared and got written off as a bad loan. Yeah, but it's a very good point. And then the other thing that is instructive on this one is looking at corporate debt excess. So what's actually driving corporate debt and so on. So and what's the outflow from that? So if we look at something like free cash flow, and this notion of free cash flow is if I'm a company, I've paid back all my operational costs, I've paid my employees, I've paid my tax, what have I got left? I've got some money to pay back the people who I've borrowed money from, and I've got some money to pay back my investors, my share investors. So that's the notion of free cash flow. How much have I got to actually pay back the sources of my capital? And so we've seen that, you know, free cash flow available for companies during the previous recession, or during this period here, was quite flat, okay? So the economy wasn't growing, yet dividends and share buybacks were going up and up and up. So companies can only do that in one of two ways. They can either have a stash of cash in their bank vault on their balance sheet that they're able to pay back their investors and go, okay, well, yep, even though our free cash flow is flat, we'll take money out of reserves to maintain those high dividends that you all really enjoy and you want to spend on your holidays and so on through that period. That's one source. The other source is you go and borrow the money. So you can borrow the money at 1%, pay back your investors at whatever, and hope that, you know, at 2%, 3%, and hope that eventually, you know, comes back in and I can, you know, earn enough money in the future to help me pay back the debt that I've used to pay back your investment. So this is a bit of a Bernie Madoff type of, you know, pyramid scheme where I borrow money to pay back my investors and hide the fact potentially that I'm actually doing well when in fact I'm not. I'm borrowing at cheaper rates and paying it back at, you know, paying back expensive rates. So that's the trouble there. We have this big, you know, fat in the system. I'm using debt to pay back my investors, my share investors especially, and same thing is happening here. Free cash flows aren't doing terrific in the US. Profits are high, but free cash flow, after I've paid all my taxes and so on, they're not so high. So there is this gap here. So that's fairly scary. And that tends to happen a lot, but it has been happening for some time, okay? So we think that there was a lot of cash reserves in many US corporates during this period here, and they're just using those cash reserves to pay back those dividends. You know, the loyalty sort of thing, the loyalty premium to their investors. Keep investing in us. We'll eventually come through the bad times and come out, through the bad times out to the good times, yeah. Yes, sir.
The last spike, what do you call it? A result of Donald Trump's corporate new tax policies.
It's not a bad idea. It's actually a good suggestion, I think. So In the US, yeah, that's probably true. So the US has just released a tax policy or tax shift last year where company taxes were 35%, now they're 22.5%. And so that's come right down, as well as a holiday in taxable income for companies who repatriate their wealth back into the US. So large companies, if they're repatriating their wealth back into the US, are not going to be double taxed. So they get a dispensation, I think, and they don't have to pay 15% one-off tax if they bring their $1 billion that's sitting in Ireland somewhere, bring it back into the US and hold it in the US coffers and increase the money supply in the US. So that could be a potential indicator that credit growth has just landed on US balance sheets instead of being on some offshore balance sheet below the line. So, yep, probably a good suggestion. Okay, so I guess the trouble is we know there's a recession going to occur. We don't know when. It'll probably look like different types. We're going to suffer some pain during it. But what are we actually looking at? If we look over the previous 60 or 70 years, we see that the bull market increases, and this is, I guess, an investor-centric slide. We see the bull market go up rather dramatically in between each of these recessions, and the bull markets tend to last much, much longer than the bear market recessionary periods in between. So the average bull market return for each of these epochs in between recessions was about 263%. So if I invest $1, I get $2.63 at the end of that bull market over that period of time, on average. And it lasts for 71 months, so 6 years. The average bear market, in response to that, has a decrease of 33%. So that's hard to take when you see your wealth go from $1 million down to $600,000. That's tough to take. But be comforted in the fact that that's only going to last for 14 months, and then hopefully that'll be over, and then the next bear market will start again, and off you go for your next round of 263% increases. So this is meant to be the comforting slide to make you feel better about a recession, that it's not going to last forever, it lasts about a year, and then you tend to come out of it. Now, the last one was pretty deep and lasted a long time. The question is, will the next one be even deeper and deeper again? Okay, so I guess the mathematicians in the room will go, look, this looks like a Fibonacci set, and you can see the numbers starting to increase, more dramatically as you go through time. So given that pattern, we would expect that, but of course, economics is much more complicated than that, so we can't really rely on that basic fact alone. So, look, market declines do look less daunting with longer term perspective, and this is just looking at the market declines themselves. I guess recessions are painful, but I guess this is just another representation of the previous slide, but expansions have been powerful. In the US, recessions occur roughly 12 to 13% of the time. In Malaysia and Singapore, it's much shorter. Australia, much shorter again. So Australia hasn't had a recession for about 30 years, so quite a long time. Singapore does swing wildly because it's tied to certain things like oil prices and growth in the Asian region. Malaysia, much less volatile than Singapore, but certainly Malaysia hasn't suffered a bad recession since '97, I guess, since the Asian financial crisis. So Malaysia has done pretty well as well over the last 25 years, 20 years at least. So long bull markets for Malaysia, stretching from way down here all the way up. Okay, so these recessions don't last long. Maybe 10 to 13% of your life is spent in a recession. Yes, sir.
Does this rely on the policies of the government?
Yeah. So
from the recession to recovery.
Yeah. So that's a good.
We need to depend on the policy.
Yeah. So that's a good point. So sometimes the policies work. So that's a key question. So the big recession, obviously, back in the Great Depression. In 1929, 1930, 31, 32, obviously there was a need for government intervention into that recession. So generally what happens in a recession, as you know, is that things are tough, I haven't got extra money to spend, so I won't, and then so no companies are going to be able to make money building a washing machine for you because you're not going to buy a new washing machine because, money's tight, right? So it's a vicious circle. You don't spend, they don't produce. You don't spend, they don't produce, and you get this vicious cycle. So I'm not an economist, but I'll try and do my best. the monetary economics that Keynes advocated in the 30s was that, okay, there's no growth in the consumer cycle, so how about we get some growth going in the government cycle? So if the government spends money, a fiscal stimulus, call it, and builds a dam, builds roads, builds highways
That's
here
right.
and there, railways, that will generate growth in the economy. That's that big infrastructure spend at the government level, and hopefully that will cascade down into the private sector.
Even if the policies are not good, it might take a longer period for the recession.
Yeah, exactly. So that's one way of doing it. But it seems that monetary kind of way of dealing with recessions is no longer working as acutely as it once did, because people see through it and they go, okay, well, the government program's only going to be so long. We know it's going to end, and government programs tend to, fall off a cliff. They tend to stop. If you're building ships, you build 10 ships and then that's it. They stop. You don't keep building ships. So that tends to be the problem. During the last recession, of course, the complication in the US was that the financial system itself was under great strain, and there was a need to inject money into the economy in a different way than it had in the past. So generally, for all this time, the US was able to just pump money into allow credit to be created in the system, in the economy, in a way that was as cheap as possible. And so when we create credit is easy to create, right? I sell you my car, you agree to pay it back to me in a year for 20,000 ringgit. We've just created credit, It only comes to the crunch when I actually want the payment for that. And that's when the big crunch comes. So we can create all this credit. That's easy to create. This money, so-called money supply, is created through that process. But in the US, that only lasted so long, and they went, okay, we actually need to increase the money supply genuinely. So we have to invent money, and money is we could talk for weeks on what money is, right? So don't get me started on that, because I don't know the answer. But the way we sort of create money, this was that quantitative easing, was actually to print money and just invent it. Here's $700 billion worth of money that I've just invented, now go and spend it. And so that's what the quantitative easing program was aimed to do there. Now, whether or not that in itself will help trigger the next recession is a key question. So most of the central banks are now getting to the point to create growth in the economy. They've lowered interest rates as far as they possibly can. Where's the next stimulus going to come from? That's the monetary policy side of things. The other side of things is the fiscal policy. All you can do is get governments to borrow money from overseas, so countries that have excess capital like Japan and China, use that to create this spend. But once again, it's a government initiative. It's not really a private sector initiative. So that it is a key point, and that's the distinguishing factor, I think, between all of these recessions, is that what's the response, and the response has been different each time. Yeah, so look, I'm doing it from a selfish view, going, okay, I've got my money, what am I going to do with it, where am I going to put it? So I'm just going to stick to that. So I'll try and speak less about economics, because I've probably made 1,000 mistakes already in everything I've said and contradict myself 10 times. So, yes, ma'am.
Hi, sir. I've got two questions. Now, back in the, my question number one, back in the 1980s, mid-80s, the world is not so connected by internet at that time. So, and then we had the so-called Soros-caused recession. That's a big one, and it affected globally. And then, I think back about 3 years ago, where there was some oversupply of crude oil, and then there was the crude oil global price fall, and that affects generally globally, and then but more particularly the Asia region as well, because we depend very heavily. The countries in Asia depend very heavily in the income that they sell petrol. So throughout comparisonly the previous recessions till Soros and then the current ones, do you actually see that the impact of a recession has actually moved from global effect into more regional, or more like a spot countries, group countries like kind of recession? That's my question number one. Question number two is the what are called the recessions that we went through I wouldn't say recession because no economist has actually come up to coin it as recessions for the oil price caused economy downturn 3 years ago, and I think we are still in it, like what you mentioned, that we don't really know that we are in a recession until we are out of it. So, which I think that the Asia countries, particularly like Malaysia, Singapore, we are still in the sort of a downturn economy this 2-3 years. So, do you actually see that the difference in the recession nowadays, that it's not like such a big impact because of nowadays people get the information very quickly due to internet and all that, so government can come up with fiscal policies very quickly, and the banks and private sectors and all that. So how do we actually be ahead of recession the next time that it hits us? Thank you.
Good. So that's a pretty good question. So I'll answer the second question first if I can. So the definition of a recession is just 2 consecutive quarters of negative GDP growth. That's the kind of economist, But we all know when we're in one, right? We know that, okay, I didn't get a bonus this year, my pay packet is not increasing, and, my hours have been cut or whatever. So we kind of know when we're in a recession, things are tight, prices are, subdued and so on. So there's the general feeling of a recession economically, and then there's the formal definition, which is that 2 consecutive quarters of GDP growth decline. So I guess consolidating those 2 things is the first problem that most people struggle with, and governments will only act when they have a specific number that they can act on. So when they see the second number come in, they go, oh right, crap, we're in a recession. Let's invest, fiscally now. So, but then it's too late. You're already 6 months into that cycle. It's declined so much, and then you're trying to get out of it. So, most central banks, and Malaysia's central bank is no different, are getting pretty good at predicting. Okay, they're just taking these numbers. These numbers are fairly public. There's no secrets here. They're pretty good at predicting. Okay, we've got 6 months roughly. 6 to 12 months until the next recession. So, how do we get ahead of the curve and address it? Reduce interest rates, increase, supply in the economy, those sorts of things. There's limited amount they can do, and sometimes governments are just happy to let the recession occur, like let it happen, wash out the fat from the system, and let the economy start to pick up again. So sometimes there's limited things that they can do. They, I guess, are concerned mostly with unemployment. That's the big thing. If too many people are unemployed, then they get bored, and when they're bored, they start riots and all that sort of stuff, right? So you don't want that. So you need people gainfully employed, happy, kids in school, the economy's still growing in some manner. So that's what governments are trying to attack, I guess, less acutely now than they did in the past. To answer your first question, the regional versus global flow of capital, look, for as long as I've been in banking for 20 years or so, the flow of capital is still pretty good, pretty efficient, but there is still geographical bias, massive geographical bias. And so the US, if you're a US capital investor or a lender of funds, you will think US, or you'll think foreign, or you'll think emerging. And that's how they tend to bucket these things. So emerging, Malaysia might be in the emerging space for one capital investor, or it might be just overseas for another. So they tend to think, okay, let's just take that bucket and invest that $1 billion in US bonds, that $1 billion in Southeast Asian bonds, and that $1 billion in the Eurozone. They'll tend to think in those large geographical spaces. But the actual flow of capital, so Malaysians accessing US capital to fund projects here, that's still pretty good. I think that's still pretty efficient. There's no bias necessarily against that. It's only when capital controls come in, and this is what Dr. Mahathir did in the late 90s. He went, okay, boom, shut that down, stop exchange rates floating, let's stop the outflow of capital. That scares markets. That sort of stuff tends to scare markets. But at the time, probably saved the economy of Malaysia, as opposed to Thailand, which didn't do that, and they copped it big time. So they had a massive recession. Malaysia didn't. So those kind of heavy-handed tactics that governments are starting to use are becoming more prevalent. In terms of the oil thing, Malaysia's income is tied heavily to oil. That's true. And it just so happens that the US is now, with the growth in technology through shale oil and tight oil basins in the US and Canada, they're oversupplied in oil. So it's now switched the whole conversation around. So Malaysia will still earn good income from oil. The oil reserves in Malaysia are low production costs, fairly good margins. Will always earn great income from that because they're in easy to get spots and they're close by, and you have a functioning economy. Petronas is a great company, always at the edge of technology, so doing fairly well. But yeah, there will be that limited upside. There won't be $100 barrel on oil prices again for some time, it seems, just because of that US dynamic has now switched.
Always use the U.S. Figures, past history to study and predict, right? But would you actually see China, the upcoming economy, the next big economy coming up, that it could be an effective factor for the next recession to occur?
Yeah. So it's US data is easy to get and it's available and it's transparent generally, and it's easy to understand. Chinese data are less easy. Stock market data out of China, you think, well, look, the stock market there represents maybe 10% of the investments available there. So once you're only looking at a small sample, and most of that 10% have significant government ownership of those companies anyway. So, you can look at the Shanghai index. I tend to take it with a grain of salt. It doesn't really mean anything. It's just a bit of marginal, fluctuations in value there. The deeper numbers in the China. So if we were going to do the same analysis on China as we're doing on the US here and other countries, would be much, much more difficult because debt numbers aren't reported, housing starts aren't reported, unemployment, who knows? They're a lot harder to get hold of. And I think China's just a totally different dynamic altogether. You've got multiple countries almost in China. It's not really one big country, as you know. There's lots of fighting jurisdictions, but within themselves. So that's a question I can't really answer very well. But yes, it's a... Yep. Yeah, I always will. That's just people shaking their guns at each other. It's not really. I don't think it's a long-term thing. I think it's just a bit of gamesmanship going on to try and reset the international scene a little bit. I think China has done fairly well in keeping its interest rates low for a long period of time, dominating the industries or some industries in manufacturing for a long period of time, and it now owns the total market share. It's the dominant market producer in those. So now the rest of the world is going, well, hang on, you're dumping this stuff on us at low price. We've enjoyed low prices for a long time, and now prices are starting to rise, and we can't buy it from anywhere else. So, yeah, dependency. So they're not dumb, the Chinese, no. But thanks for your questions. Yeah. Okay. So yes, average expansion pretty good. Average recession not so good. Lots of jobs lost. Return still positive over that period. That's just because of coming out of it's pretty flat basically. And then the GDP growth suffers big time. So that affects all parts of the economy. Okay, so is there upside? Well, in terms of market downturns, if we divide market downturns into 5%, 10%, 15 and 20% declines, 20% declines happen every 4 years and they last for almost a year. But 10% declines, this is more of a correction than a decline. It's fairly rapid, okay? After 3 months, you'll see it start to wash through. And we see these fairly regularly. Every year, you'll see some sort of correction occur. Now we're interested in working out what the upside to this volatility is. And then once again, this is just another depiction of seeing, okay, well, what happens in year to year where volatility, so standard deviation of stock returns over that year, is it when it declines by between 1% and 2% is the green bar, when it declines by 2 to 3%, 3 to 4% or 4% and above. So we see in 2008 quite an even or roughly even spread of large declines through that year, volatility through that year. So we're seeing prices go up and down fairly rapidly, but large price decreases during that year. And at the moment we're starting to see the grey bar here starting to peak its head. So there's a lot of volatility in the market. People are nervous, and when they're nervous, they tend to buy and sell their stocks more rapidly because they're a bit worried about, well, I'll just, start to withdraw some money, put it over there, put it over there, put it over there. You see this volatility start to occur. So it started to spike there. It did spike here as well, but then declined. So, once again, these are all just sort of leading indicators. All right, so I guess we get to that point. We go, okay, I've got some money, I've got my company, I've got my family, I've got all these things that I'm doing. What am I going to do about it? Right, so the first thing you need to do is get rid of emotion. Take emotion out of your brain and just get rid of it and stick to rational thought. Okay, so during the previous recession in Australia, not recession, sorry, I guess the global recession that occurred, the greatest switch of cash from shares into cash, the greatest transfer of wealth from shares into cash occurred right at the bottom of the market. Market declined by 30%. Everyone went, holy hell, I'm taking my money out and I'm going to put it into cash. Now that is the worst time to do that, okay? So investors will often sell right at the bottom of the market. And then when the market's going great, house prices are going up, I better get a house. Oh, they're going up again, I better get another house. At the top, investors often buy up here, like it's ridiculous, So we always buy high and then we always sell low, which is the worst thing an investor can do. But that's because we're governed by this bloody thing here, right? We can't get around, we can't get away from it. So it's emotion drives everything. So what can we do with it? The best thing you can do is to stay invested in the market during the period of the recession. So if I was to just stay invested for the entire period over all of the recessions we've looked at, then if you just stay invested over that period, prices go up, down, up, down, up, down. Then if I started with $1,000, then over this 10-year period from 2009 to 18, I would have started with 10 and ended up with, 1,000, I would have ended up with 2,775. Okay, so just stay invested. If I went, okay, well, let's take some money out and I'll put it back in when I think I've timed it correctly, then, and if you miss the 10 best days in that period, then you'll have lost about $1,000 as opposed to the guy or girl who just stuck their money in the account and left it there and forgot about it and went on holiday and came back 10 years later. They would have got that. If you're there actively trying to trade the market and you missed only 10 days over this 10-year period, then you would have missed 61% of the return. If you missed 20 days, you would have missed almost all of it. If you missed 30 days, you would have lost value. If you missed 40 days, you will have lost $300 as opposed to making $1,775, okay, on that investment. So it's critical to kind of understand that investors, advising your investors or your potential clients to switch in and out, time the market a little bit, is a very tricky thing. Now, it's not to say that some people still make money, because there are people down here who will have, traded cleverly and made much, much, much more than that. But unless you're on the Bloomberg terminal every day, watching your investments, watching your stocks, doing your analysis, it's going to be impossible to do. So timing in the market is much, much different versus time in the market. There's also value to be had. This is, I guess, a representation of what goes on during a year. So if I'm just investing a little bit every month, then I'm buying shares. I buy, if this is the price per share in green, and this is the number of shares that I buy in blue, then if I buy some shares, I get that many shares. I buy some at $15, I get that much. Price goes down a little bit, I can buy a little bit more. When the price goes up, I can only buy fewer and fewer shares as we go. Okay, so this occurs over the year. This is just a representation. This is not actual. You'll get these months where you're probably overpaying for shares, but you'll also get these months where you're underpaying for shares potentially, and you can acquire many, many more shares. So even though its cost, the average cost of the shares over this period appears to be $15, that's the average cost. In actual fact, the average cost was about $13.64 because you took advantage of these periods when the price was substantially low and you're able to acquire a number of shares to add to your portfolio. So even investing through the year is much better than this sporadic, 20,000 here, 10,000 there, 20,000 there. So the gradual increase in wealth can be generated by just steady investing through time. And then, once again, we have to take into account the fact that correlation is our saviour in many cases. So if I plot from 2009 to 2018, which asset class, and an asset class is basically US stock, US bond, foreign bond, US property, foreign property, all these big, broad investment themes. You see that there's no general thing that outperforms in any one year. 2009, emerging markets outperformed everyone, and cash underperformed everyone. This year, cash is beating everyone. 2018, cash is beating everyone in the US. If I just invested in cash, I would get 1.8%. If I invested in emerging markets, I'd get negative 15, right? So this is where the trick is in having a broad spread of investments that are taking advantage of these correlations. Diversification does matter a great deal because you can't predict where the black square is going to occur next year. You just can't. You can try, but no one's successfully been able to do it. So that can help lower volatility within your portfolio. And then the other one is just invest in specific sectors that tend to react better to recessions. And they're always the things that we have to rely on. It's utilities, it's staples, it's healthcare, it's telephone, it's electricity. You always have to pay for electricity. Company knows that. You always have to buy insurance. Companies know that. So they tend to ride out these recessions fairly well. So even though the stock market in these recessionary periods returned fairly poor returns, lost lots and lots of money, the dividend yield for things like consumer staples, utilities, healthcare, telecoms, energy, materials, all made money. So retreating into the more defensive stock areas that are available to you is one way of dampening out some of that volatility. We see now US investors looking more overseas, and this is where Malaysia will benefit most from the US current cycle, is the fact that banks are overpriced in the US relative to Asian and Eurozone markets. ExxonMobil is at leverage ratio at PE ratio, at 13, so price to earnings ratio at almost 14, or I can invest in Total, European based, at 9. Same thing for the other general themes. I could invest in Apple. It's a little bit overpriced. For half the price I can get Samsung, and they're in the same market share roughly, etc. Okay, so this is where I think Malaysia and Singapore and other Asian countries will benefit most from you investors started to shift their need for a investment in telecoms to one that's a bit more targeted and is likely to earn them a better rate of return. Bonds are always a good hedge. So bonds, as interest rates go down, the price goes up. They're inversely related. So we tend to see that bonds do act as a nice anchor for dampening some of that portfolio volatility. So if I had no bonds in my portfolio, I would lose that money. But if I had some bonds in my portfolio, I would gain some during the flash crash and all those recessionary periods there. So we all know that bonds act as a fairly good hedge, and that's one way of depicting that. There are particular trading strategies we can look at. So if I was to look at investing in the market, so if I'm investing in stocks, then on average, stocks have a 15% volatility as measured by standard deviation of annual returns, and the returns are roughly, say, 11% year on year, through time. We all know that, look, bonds earn less but are less risky. Cash earns much less but is much, much less risky as well. With equities, we don't have to just invest in the stock market. I can pick which equities I want to invest in. If I use beta as my measure, and beta being a kind of correlation measure where beta of 1 equals the same risk in the market, a beta less than 1 is an investment that's less risky than the market, much more dampened, so that's utilities, telecoms, those sorts of companies. If I pick my investments just based on the relative volatility, so the volatility of those stocks relative to the market, and just pick the lowest quartile of those stocks, then I have a low beta portfolio. And if I pick the highest quartile of those stocks, I have a high beta portfolio. Then, so for the high beta portfolio, I'm earning almost 13% at 25% volatility versus 11 for half the volatility for a low beta stock. So this beta does get fairly flat. You still will increase your returns, but at what price? And this is the price. So when the losses sting is what occurs with short-term investing. So if I'm just interested in looking at short-term investments, then during a recession or overall recessionary periods, we'll see that the average return for the low beta stocks is still relatively good at that 11%, but it will only draw down half the amount of time during those recessionary periods relative to high beta stocks, which will draw down much greater amounts during those recessionary periods. And there's a bit of an even spread of the other quartiles through there as well, quintiles, sorry. And then we can see that, okay, well, if I was to just go for a flat 60% investment in equities and 40% investment in bonds portfolio, that looks safe, but is probably not as safe as investing in just a standard low beta portfolio, stocks that are relatively resistant to recessions. That's one way of defeating that. And all of this is just simply looking at the beta of every stock, ranking them, taking the bottom quartile, the bottom quintile, the bottom 20%, and investing in that. And that's my portfolio right there. So investors like simple strategies that they can apply, that have some system to it, and that scientifically can be proven to work on average. And in terms of long-term investment, so if I was to invest and hold on to that investment for 20 years, then we see the low beta stocks generally outperform the high beta stocks over long periods of time in terms of their in terms of the trade-off between annualized vol over that period and the return. So look, once again, other way around. Low beta stocks suffer when I'm looking at longer term periods because they're earning a much greater volatility over that period during the recessionary cycle, whereas the high beta stocks do outperform. So if I'm happy to just leave my money in that investment for 20 years, ride the ups and downs, then we will outperform the low beta stocks. So it depends on your investment. And I guess what I'm trying to get to here is what is risk? It depends on what your measure of risk is, okay? So I do speak to some people and they look at stocks and they go, stocks are really risky, why would you invest in those? And they're only really risky because we measure them every time there's a trade, okay? There's a trade of a stock, what's the price? That's that. There's a trade of a stock, what's the price? And we can plot this all the time and we see it, blah, blah, blah. It goes all over the place, right? So it's very volatile, it seems. Housing, you go, housing's not very volatile, it's always flat. But that's only because we buy a house once every 5 or 10 or 15 years, right? If I bought a house every day, it would look like this, right? If I came to your front door and knocked on it and said, how much is your house? You know how much your house is worth today? It's worth 200,000 ringgit. And then the next day, 200,001 ringgit. Next day, 202,000. You'd go nuts, right? You'd go crazy. You go, but that's what stocks are versus real estate, property, other investments are much less volatile, apparently, but that's because we measure it differently. So it's a manner of working out, okay, well, how are we actually measuring this volatility? Is it mark to market daily or is it mark to market annually? If you just measured, returns from 37 to 38 to 39 to 40, you'd see a much smoother curve and it would look much less volatile and it would look like a property curve, okay? So it depends on how we measure it. But generally, equities still outperform over the long term, even though they're highly volatile. And risk also means different things to different people, okay? So it depends if you're young, it depends if you're old, it depends if you're in retirement. So if I'm just investing in the market and I'm hoping for the best, then the risky investment is the small cap stock. So small companies always outperform large companies. We know that. You have to pay a premium, you pay a premium, you earn a premium for the money that you invest in small cap stocks versus the S&P 500 large industrials. And then we measure that relative to, say, the high dividend yield index companies. So dividend paying companies are like utilities who are certain of their income. They can pay dividends fairly reliably. They tend to outperform everyone else. Okay, so that's one measure of volatility. A different measure is to say, okay, well, what's the downside of a particular strategy? So this one is looking at, say, the capital appreciation for a young investor. So if you're investing, you're 20 years of age, you want to invest so you've got as much money to retire on when you get to 60 years of age, then that's risky, right? You don't want that. You want as much as possible. You want to invest in this thing, which gives you the greatest return. So for a young person, that's the riskiest investment relative to someone who's just investing in the market year to year, where that's the riskiest investment. If I'm retired, I've got money invested in the market, but I'm also withdrawing money out every year to live on, then if you look at this, then that's the riskiest investment. High dividend yield index, that's the risky investment. It's not earning me enough to pay for my lifestyle. Yes, it's relatively good growth. It's less risky on a day-to-day basis. But in terms of me withdrawing money over that cycle, this ends up being the riskiest investment, and the high dividend yield one ends up being much, much better, particularly if there are tax breaks embedded in some of the dividends that are paid, to which Australia investors they are. So you have to be very clear about risk and what you're talking about. Uncertainty is not the same as risk. We've got 2 slides to go. One other way of defeating volatility is to, instead of just investing in whole asset classes, stocks, bonds, cash, real estate, infrastructure, whatever, commodities, I can look at thematic investing. A lot of investors are now adopting this as an approach. So I'm going to invest in particular themes. Obesity is rising. Healthcare is going to be an acute earner of income in the future. How about I invest in healthcare? And how do we invest in healthcare? Do we invest in stocks? Do we invest in hospitals? Do we invest in pharmaceuticals or drugs? It's thinking about a theme of investing. So you might find yourself investing in real estate and in all sorts of things, which is actually dominating a theme of pharmaceutical investing as opposed to investing in the pharmaceutical companies themselves. Look, and there are companies that allow you to invest in these thematic portfolios. Utility bills, renting, people seem to be renting more than buying at the moment, so how do I make money out of that? Used car, tune-ups, medical devices, all those sorts of things. So how do we invest in themes rather than specific asset classes, which is the bolder way of investing? And then I guess these are some recent strategies that capital partners looked at, and that's advising investors to look at these 3 things. So cloud computing seems to be a big growth area. Service spending, 153 billion a few years ago. It's expected to double in a couple of years. Okay, so you look at that, you go, okay, well, how do I invest in cloud computing? Amazon Web Services, Microsoft Azure, a couple of other big contributors in that space. Maybe they're worthwhile investments. Or do I invest in the infrastructure itself? Do I buy a data center in Arizona or Nevada or somewhere? How do I invest in those sorts of things? But
Prof, I think so for another decade, cloud computing because of the growth in
Technology.
exactly, yeah. Everyone agrees that it's but then the question is, well, how do I invest in it? Do I invest in Amazon, who's also got books and it's a retail kind of hub? How do I invest just specifically in cloud computing? Yeah. So do I invest in Cyberjaya? How do I invest in Cyberjaya and take advantage of that? Do I buy real estate there, or do I invest in a startup there? These are the questions that people start to ask in those broad investment themes. Same with pharmaceuticals and airline travel. So in Asia last year, there were 100 million people who got on an aeroplane for the first time. Okay. So you think, okay, well, what's that going to look like next year and the year after and the year after? They've gone once, they're probably going to go again, so there's going to be growth there. How do I invest in airline travel, though? Do I invest in airlines or airports or taxi? I don't know. These are broader thematic questions that it just presents a new interesting way of thinking about investment themes for some people. And that's all I had. I hope that was of some interest to you, and any questions, please?
All right, thank you very much, Jason. We've got time for a few questions. Thank you.
I think based on your inverted yield curve, US went in last March, right?
Yep.
So 15 months from that, it will be June next year.
Yep.
So you think US going recession next year?
That's the general consensus. So I was at a conference in the US a couple of months ago, and that was the general consensus that in the lead up to the US election in 2020, they'll be likely to be in the middle of a recession.
When is the US election?
End of next year, I think. Yeah, November. Yeah. Yeah, 2020. Yeah, end of next year. So, but we won't know you're in the recession until 6 months has passed, because you'll have seen GDP decline for 3 months and then GDP decline for the next 3 months. So the recession won't be evident until 2021
2021. But
is when we'll know about it, but it will have occurred in 2020. That's
you mean the lag in reporting,
lag in reporting. Yeah.
reporting timing.
Yeah.
So you're seeing the recession be in November, October?
Well, I can't. I'm just saying, on average, that's the average.
Because if the recession comes in June, then the report will come out in September.
Yeah, December. Yeah, that's right. Yeah, that's right. So, and so, I guess how does that affect Malaysia is the other question. So the US will be doing whatever it's doing, but does that affect Malaysia? I would say Malaysia is pretty well protected.
No, it will affect Malaysia because Malaysia is a trading country. Our trading is more than our GDP, so it will affect Malaysia.
It is, but US still relies on Malaysian goods and services and supply. Oil prices here in Malaysia, like the oil revenue dampens a lot of recessionary behaviour. Property, still going pretty well. So I'd be careful about predicting a flow-on effect into Southeast Asia. I mean, it will affect Europe and Canada, probably China and Japan more than it will affect Malaysia, I'd say. But there's likely to be a dip, yeah, for sure. Capital will be more expensive to get hold of. So if America is reluctant to invest abroad, keep their money inside the US, well, just, it's always a flight to quality during a recession. So you tend to stick your money where you trust it more. There'll be a bit more of that. However, I mean, there are large pension funds, there are large investment funds in America still looking for yield. And if they can't get yield in America, they'll look for it elsewhere. And so that's where Malaysia will benefit. Yield in Malaysia is, I guess for investments, is it 2 or 3% above alternative investments? So it's still an attractive investment hub. Stable, secure government, capital flows are easy, taxes low, generally relative. It's easy to employ people here, good quality people. It's still an attractive place to invest.
What's the reason for the US recession next year? Because 2009 is because of the credit crunch, right?
Yep.
So this time around, what is the reason?
Yeah, good question. It's hard to say. It could be mortgage-backed securities again. It could be, I think, just an oversupply an undersupply of employed workers. It could be anything. There's always going to be something that triggers a clean out of inefficiencies. There are inefficiencies in America. It's just a question of where they're occurring. Costs are going up. Cost structures in US companies are going up. They're holding a lot of cash, but things are increasing in cost, energy, and so on. So it's hard to say.
This Trump, he reduced interest rate, but increased government spending and reduced taxes. So where is he getting his money to finance all this?
Yeah, they're just borrowing it, basically. So
They're increasing the money supply.
yeah, yep.
So why is the US dollar still not falling? I mean, it's still,
Yeah, I guess the US has an uneasy relationship with credit. Credit is fine. There's nothing wrong with credit in itself, so long as you can afford to service that debt. You can service the debt if you grow, and if you grow, that means you need either internal growth, domestic growth, or you have to import the growth in somehow. So China's okay. They've got a lot of domestic growth, a lot of spare capacity in there to increase. There's 600 million people still on $2 a day in China, so there's a lot of people still to contribute to that urban growth. In America, you'd say, well, there's no one there on $2 a day, so where's the growth going to come from? It has to come from immigration, so that generates growth, or capital repatriation, that generates growth. So that's the only thing that will save that. If you're going to grow your debt, you need to grow your receipts, your tax receipts, so you can pay back that debt.
Yeah, but he reduced taxes.
He reduced the tax burden, hoping that the increase in growth would greater than outperform the reduction or the loss in taxes. And it was really only just a reduction in company tax. Income tax is still pretty high. So they've still got receipts coming in. They're just trying to attract companies to invest back into America, reduce the overall tax burden, but the overall take is expected to rise.
In the front here.
Professor, thank you for an insightful presentation. Like people like me, I don't know when I went into recession, or I don't even realize how many recessions. I don't understand that. Things get expensive. Any advice for people in the education, training, and people development industry?
Yeah.
Any advice for people like us?
Yeah, it's a really good question. And I think education sits in here somewhere, like I would think. Like it's a fairly stable, reliable source of income. I don't know about in Western countries, but in Asia, I know that education is very important to many people. It's seen as an investment, not as a thing that they should do. Like it's not, free college party time. It's an investment, like for their future. So I think that many Asian people in the Southeast Asia, Japan, China, prioritise investment in their education very high. So I think they're up around here, utilities, consumer staples and so on. So I think there's a lot of stability in education, although I don't have the data to back it up, so I'd have to do some research. But I think there's some, reliable source of education income to, be had through this period, as opposed to industrials and financials, which do suffer from.
Thank you. But can I go? Yeah.
But if you've got data to, refute
No,
that.
the second one is, what I see in the region is the minute we hit recession, what organizations do is cut their budget on training and development. What's your view on that?
Yeah, they do. But you need to hold them to that. Like if they're halfway through a degree, then you go, hang on, you've got to finish a degree. If you can anchor them into some point where they have to finish that pipeline of work, then that would be good. It's a good question. I don't know the answer.
Yeah.
It's a good question though, because you're right. Companies have to cut costs, and the first thing that goes is, Christmas party, or Ramadan party, and training budget.
Thank you. Thank you.
But Prof, I think in people who are retrenched due to the lack of the technical skills or qualification,
Retrain.
they tend to come back into the
To
education.
retrain. Okay, that would be interesting
And what
to
we
see
have
that.
seen in the 1997, 98 in Malaysia.
Right.
What
Yeah, that would be really. Yeah, I guess that's true. I've never.
we have
never
seen in the
that.
increase. I was with one of the colleges which just started at that particular time, and we saw the growth tremendously,
Right.
especially in the part-time. So we used to have part-time 6 to 9:30. That growth we have seen tremendous.
Right. So it's
Impact,
in there. So it's
what
a
we have
reliable
seen,
investor.
yes.
So invest in IAG. Is what
Yes,
you're saying.
yes.
Okay. Buy shares in IAG.
I have one question here. Sure, okay.
Yeah.
The Malaysian Institute of Economic Research keeps warning us that consumer sentiment index is low. Purchasing power has become quite stagnant actually. And property prices have spiraled up maximum in Malaysia right now. It has become so unaffordable. So what is the
So this is, and I think Malaysia is going to replicate the US in exactly this depiction here. When the yield curve inverts, you've got some time till you know you're in that recession. But these things housing starts will be the key indicator. And housing starts in the US are a little bit different. That's when you're just looking at residential housing. I'm going to build a house and I've put down a deposit and paid for it, as opposed to a developer building a condominium and then going, okay, I'm now open for business. So I think it's a little harder in Asia because you just build these big condominiums and then hope that people, come along and invest in them. Whereas as the occupier of that house initially. So you do see it much more acutely. The credit growth, so corporate profits, I guess is a leading indicator of credit growth. I mean, one indicator of the recession, or like a pending recession, is the growth in credit versus the growth in GDP, or inflation at least. So if you see credit growth, really increasing well above GDP growth, which is what's happening in Malaysia. So GDP is flat, GDP growth is fairly flat, but credit's increasing because interest rates are coming down. That tends to indicate that inflation is about to increase. And then the question is, well, does inflation start to increase too quickly to rein in? And what happens when inflation increases rapidly is interest rates increase rapidly, short-term interest rates increase much more rapidly than long-term, and then you get this instant, reversion of the yield curve. To pull back on that credit growth somehow. So they pull back on the money supply, increasing their interest rates even higher, trying to arrest that growth. So Malaysia's in an interesting, position. But this, I think it's the credit growth and housing starts will be much more of a leading indicator than anything. If people start to stop borrowing money to build or buy their house, then that will be a much more acute indicator than anything else. Yeah, thank you.
Very good. I think we'll leave the questions till after now. We'll let you off the hook for the moment,
Thanks,
Jason.
Caroline.
I'd now like to invite Dr. Anthony Das, Chief Economist of AmBank and also Head of Research, to come and say a few words in reply and also a vote of thanks. Welcome, Anthony. Anthony is also an adjunct professor. Thank you.
It's better to pick apart all my arguments and find all my faults.
Right, good morning. I don't think I need a mic. My voice is actually loud. Oh, okay. First and foremost, I must thank IEG for inviting me here on behalf of AmBank Group to talk about this topic called volatility, uncertainty, ambiguity, and complexity. It's all very complex here. Okay. I think it was a very interesting presentation by Jason, and I'll just add on from there. If you look at the whole situation today, it's really very challenging. The whole thing started off from 2008, following the the global financial crisis. We started off with the US debt crisis, and I don't think the whole world actually came out of it. And what we are seeing today is generally the entire global business is actually growing much slower than before the 2008 global financial crisis. So that's where we are. And post-US crisis, then we had the euro issue. And thereafter came in China. We were thinking of China is going to slow down, because a lot of them were talking about the risk of China going for a hard landing and soft landing. No one really understands what is hard and soft landing here, because it's kind of very complex to digest Chinese data, generally speaking. Because when you look at the real underlying numbers, it tells you the economy is growing at a different direction, but what they tell us is totally a different number. So it's very difficult, so it's mind-boggling every month to really digest their numbers, even till today. It's not only me, I think generally most people on planet Earth. So what's happening today is that if you really look at things very carefully, it's back to the same old issues. Now we have this thing called trade tension. No one anticipated for a trade. But the very interesting part is that the trade tension is still an open-ended. It may not just end with China. It could go on to Japan, Euro. We're talking about the Euro cars. We're talking about nearly 10 million cars to be hit, and or maybe even more. Then it comes into the Asian side. So the trade tension is definitely going to be there. And if it goes out of control, you're likely to see a global slowdown or recession next year. So that's only one thing. The second part is also on the debt accumulation, two sets of region. One is the advanced economy. Following the QE coming into the picture, and people like US and all, they went in and pump primed their way through. And what has happened, we see public debt has picked up in the advanced economy. But I'm not too concerned about the advanced economy, but I think the bigger challenge is going to be on the emerging market, in particular China. If you look at China's total debt, private, public, household, they're sitting at about 330% to the GDP. Okay, we can argue back and say that Japan is also around that, but Japan is a very matured economy, well-structured financial system they have there. So, and in particular, if you look at China, the private sector debt is now sitting at 197% to GDP. So that is a kind of a time bomb sitting there. So I think the risk of a debt accumulation triggering another crisis is very high. And if that happens, it's going back to the early 80s, where we saw the debt crisis causing the global recession to trigger, and Malaysia got into a recession. The third part is that, again, if you notice, the renewed financial turmoil that could actually happen amongst emerging market or developing economics. Last year we missed it. We were looking at very closely Turkey, Argentina, which fell in line with my projection. This year, in fact, last year when we started off this year, last year initially we were looking at 2 rate hikes for US maximum, if not 1. But eventually the tide changed. Now we are talking about rate cut within 2 months. So the tide has changed. So what's happening now is that should there be any unanticipated shock, we also fear that there could be a triggering factor coming out from emerging market itself. So that is a risk still there, and it's still very loud. Then we all know about the Brexit. No one knows what's the answer. And the more recent one is the Iran and US tension, the geopolitical tension. Kind of North Korea issue has eased off a bit, but the Iran issue has picked up. Now what would happen if there is a war? My take is that US would not go in. It could be an engagement of Israel and Iran. If that happens, could that then bring back to the second oil shock of 1979, 1980? It may not be like the first oil shock of 73, 74. That's largely because today, if you look at the whole global scenario, we are very much of the 1980s, early 1980s. We have an issue of debt, global debt, be it public debt or private debt, and we also have the cost structure issue here. And the bigger challenge today is also on the global economy. We are all looking at a slower global growth. The challenge now is, rightfully, Professor Jason pointed out just now, the risk of a US heading to a recession next year. Okay, it is there. Whether it's going to go into a recession or not, we don't know, but definitely we are pricing in for a recession. At least 1 quarter negative growth was instituted by Trump should finish off or should wane off by the third quarter of this year. So thereafter, he's not going to have much stimulus impact coming in. So without that kind of stimulus impact, growth is expected to slow down. Okay? So that's how we see this whole thing. Adding to that, it remains quite unclear how euro is going to pan out, because with all the tricky issues still there, so we are expecting a slower growth in euro. China also, we are expecting a slower growth, irrespective of whatever GDP number they print, but we are looking at the whole situation coming off. So the world at large, including Malaysia, we all have a similar challenge. Coming towards Malaysia, we are a very open economy. After China, after Singapore, it's us. Very trading nation, highly dependent on especially E&E. And if you notice, the E&E sector, global E&E sector has peaked. After only it should come back into the picture. So without the big push from the E&E, export sides are actually getting hurt quite badly. Second part of the whole thing in this whole region also is the situation of your commodity prices. If you look at the commodity prices, in particular, petroleum is already coming off. And country like Malaysia, we are quite dependent on petroleum again. Since the new government came in, that was largely because of the huge leakages. From 15% of the contribution of oil revenue to total revenue, we have come back to 31%. So the big challenge is, can we get that 31% worth of revenue? Because they projected oil on a $70 a barrel, while I was looking at 62, 65 a barrel. So there's a huge shortfall. So what's happening today is that not just Malaysia, many countries around the world, they are quite limited using the fiscal deficit, fiscal policy to stimulate the economic growth. So this is a big challenge here now. So there's only limited space left, including Malaysia. And in the case of Malaysia, what we risk is very high risk of being downgraded by S&P. Negative 3.4% to the GDP. But the government has also recognized that we can go as high as 3.7 this year. That means we will miss our target for this year, and even next year. It all depends how we're going to generate the revenue. The equation for us is not expenditure. You can't cut expenditure much. It's all revenue. So where is the revenue going to come? So that's our biggest challenge. It's not just Malaysia, many countries in emerging market and developing economics itself. So what's left? What's left is only monetary policy. So it's coming back to the monetary policy again. We saw in 2008 the way QE came into the picture. But bulk of the QE money did not go into the US real economy, likewise in Euro. Bulk of the money actually came into emerging market and developing Asia because growth story was there. So that's why the market really moved up. So there was a little bit of concern. We started seeing a bit of outflow of funds. So last year, Malaysia actually reported a net outflow in terms of foreign funds. But in terms of the fixed income side, the bond side, we still enjoyed a net inflow. The trend of this uncertainty, as long as there's any one of these that I mentioned just now, happens, an unanticipated shock comes in, we expect strong volatility in the global market. So when there's a strong volatility in the global market, there's still going to be more outward pressure taking place in this region. And so what happens here is that the challenge is all on the monetary policy. If you notice, India has already cut 75 basis points, Indonesia just cut 25 basis points, Korea cut 25 basis points, Malaysia cut 25 basis points, just this year itself, okay, from the start to now. So that's the kind of interest rate cut we are seeing. China, we are already pricing in another 100 basis point cut in their reserve required ratio. Okay, and that is only for this year. And going forward, next year, we expect them to cut more of this reserve required ratio. Likewise, we are also now slowly pricing in for an interest rate cut by China's People's Bank of China. In the case of US, it's very interesting. All of us were looking at 2 rate hikes or 1 rate hike at the end of last year for this year. Then eventually we switched the story to no rate hike. Now then we started pricing in 2 rate cuts. That's sometime in July and 1 in September. Now I'm already pricing in 50 basis point cut by next week by the Fed. So that's the kind of aggressiveness of rate cuts we are talking today. So the whole dynamics have changed. So it's coming back again to the monetary policy, and the challenge is whether we are going to fall into a global liquidity trap. That's largely because if you look consumer sentiments is also coming down. So what is actually going to drive this economy back? I think that's going to be the real challenge going forward. And if you look at the long-term business cycle, starting from 1700s, we are now in the 5th wave of the business cycle. And the 5th wave, every cycle is about 50 years, except for one particular, the second wave was 60 years. The 5th wave started off in 1980, driven by ICT. Initially, I was looking at it ending somewhere 2030, but it looks like it's going to end in 2025. And we are all moving towards robotics and big data and those kind of things. So that's the 6th wave of the global cycle. And in all the past 4 cycles, it ended up with a war. It all ended up with a war. The 4th cycle ended up with the Vietnam War, followed by the Israel war with the Yom Kippur War, we call it. Okay? So now we are talking about trade war. Now, would that be continued with the Iran war coming in? So it's always a war that comes somewhere. So we are already pricing, I'm already looking at that kind of scenario because history cannot lie. So that's the way. So what is going to drive the global business going forward? Whether you are doing a retail business or whatever business, it's all back to digital economy. That's where we are moving. So the digital-based economy is what is going to drive the entire global business. Whether you are a retailer, you're a shopkeeper, or what, we are all looking into that direction. And if you notice today, we may say that a lot of businesses are not doing well, which is actually not true. When we look from the perspective as a banker, we see there's a strong pickup in online sales, in anything. Or even you're doing retail business, right up to buying a house or even buying a car. The only thing left with car is that you can't test drive the car online. You still have to physically go and test drive. Okay? All other things are going in that direction. So what's happening now is that basic business model will have to move away from the traditional way of doing business to big data. Okay, you have to learn to digest big data, and we're moving towards that direction. Banks in this country, another 5 years or less than 10 years, I would say that you will hardly see any branches. We are all moving, because in the past, it was the front end was where we saw all this digitalization. Now we are aggressively going to the back end. So when we start digitalizing things, room for corruption is limited. Room for misappropriation of fund, even in the banks, okay, is limited. So when everything is limited, your efficiency level picks up. My cost runs down. So this is the facing out checks in this country. Okay? We do not want checks anymore. So when you have this, we don't need so many branches. So what happens now? Everyone gets into the marketing world. Go and sell products. So that is the way we are moving. So that's just the banks. If you look at some of the manufacturing companies, they have also gone into the information technology world. They have moved away to robotics, even the SMEs. They are not waiting for the government. They themselves have moved. These are our clients themselves. So you see the dynamics is slowly changing. And if you look at the digital adaptation index, okay, in this region, the highest is Singapore. And then, very interestingly, when we talk about education, Singapore followed by Thailand, and then only comes Malaysia in terms of IT adaptation. It's shocking, okay? It's really shocking. And then if you talk about government adaptation, after Singapore is Malaysia. And if you talk about business adaptation, sad to say, it is Singapore, Thailand, Philippines, one shade above Indonesia. So that is where we are in terms of business adaptation of technology. So that's how far back we have gone. So this is something that I just spoke in the parliament recently, and they were a bit taken aback, but these are hard facts numbers. It's not numbers I cooked up. So I think this is where we are now. So the country really needs, if you want to compete with this whole region, let's not talk about Korea, Japan and China. Forget about them, just within this ASEAN region. We have already realized that officially 2015, Thailand overtook us in terms of comparative advantage. Officially. Despite the red shirt, yellow shirt, black shirt, whatever shirt you can call there. Okay, the political beliefs there. Officially 2017, Vietnam overtook us. So now we are actually just a shade above Indonesia. Matter of time, they are going to overtake us. So I think we kind of like living in our own ivory tower and thinking too full about ourselves with all the skyscraper buildings, but in the real life situation, we are actually falling behind. I think that's the biggest challenge. So what is the big issue today in the global situation, again, in business world? The biggest challenge we all face today is actually productivity. Okay, the global productivity. What's actually driving the global productivity today is the capital investment. It's not labor. Even in countries like US, Europe, because of the 2008 global recession, a lot of them left the job market, could not come back. So there are no more there. Asia, I give you a very good example. I never believed the unemployment numbers. We are always fully employed, 3.3%. But we are sitting on a 11% youth unemployment. Second highest after Indonesia. Indonesia's base is 244 million. We only have 30 million, of which official number says 2 million is foreign workers. Unofficial says 7 million. I don't know which number to take. Okay? So that's all Malaysians are. And our 11% is in line with China. China has got 11% youth unemployment. But what is China's population base? 1B? So you see, we have a huge structural issue, this part here. So that's why, coming back to your question just now to the Prof on training. It's nice to spend a lot of money on training, but are they really meeting the industry needs? One, are the trainers themselves qualified to train? Because there's a huge mismatch we see today. Good money has gone for bad use. Extremely bad use. Because what we are seeing today from the industry side is that we produce a lot of graduates. Okay? They can be first-class students from anywhere. We are not going to belittle the level of education. But the work attitude is extremely bad. the top ministries, standard problem. So we have a huge gap here now. The misunderstanding between what the industry needs and what the academicians are producing. So that's why the youth unemployment is sitting at 11. I won't be surprised it goes higher. The second part, what we notice here is that more and more of these youth are also moving to the informal sector. That means they want to do business on their own. They do not want to work for people. Okay? We notice that's why there's a huge pickup in the online business, e-commerce. E-commerce Malaysia, actually we were targeting only an e-commerce growth of about 25% by 2022. But we are already hitting 25% last year. So you can see the volume of e-commerce growth picking up. So that is the way forward we see things happening here. So the other part of the whole thing that she was asking just now, I think was something to do with growth, right? Well, what was it? I can't remember. Yeah, you were asking something on growth, consumer sentiments, is it? Was it consumer sentiments was yourself? Yeah, on the consumer sentiments, it is not just Malaysia's consumer sentiments is sliding, everywhere around the world is sliding. Cutting the rates is very interesting, but what we are seeing is deposits are picking up. So if I cut rates, I go on cutting interest rates. And if the money is not going into the real economy, then we got a challenge. We had this challenge in 2016, when the central bank in the month of January, we cut our statutory reserve required ratio by 50 basis points, followed by in the month of May, we cut our OPR by 25 basis points. We were hoping the money will go to the real economy, but interestingly all went to financial market. So there was a switch. So this is what we say. Rather than I see the money coming in here, it has gone there, so it did not push this economy out. So that is a standard fear now we also fear around the world. You can go on cutting if it goes back to safe haven papers like US treasuries, yen, Swiss franc, those kind of things, and gold, then you're not really driving that consumer sentiment. We need that sentiment. So what happens now? There's a catch. If I am the government, now I'm telling this government, forget about S&P, Moody's and Fitch. They want to downgrade, go and downgrade us. We just blow up our fiscal deficit because the government has to spend. Because I'm a firm believer of Keynesian. I'm never a monetarist. Okay? So I believe in that very strongly because things are not too good. But then again, we have two groups of people sitting there. One group is a socialist, extreme socialist. Then we have one Keynesian and then. So that's the challenge that is actually happening at the moment. So going forward to all your questions of whether next year is going to be a recession in US, we think it's quite likely. May not be 2 quarters negative growth, at least 1 quarter. Already, initially I was pricing in for end of this year itself. If they cut 50 basis points, then my assumptions and my calculation is very right, it should be end of this year. That's why you're cutting your rate so aggressively. If you're only cutting a 25 basis point for July and then leave with the next one in September, then it's going to be more likely next year. Maybe 1 quarter negative growth and that's it, you come out of it. But it's a 50 now, we are also looking at another 25 in September for US. So that's the way we see that the trends are going, because headline numbers are not very exciting. The other thing you got to notice is also this. Most countries are telling us that the job data are so good, but wages is not growing. We are not seeing wage growth there. So there is a lull there. So when you don't have that kind of wage growth, so how is your consumption going to pick up? We need that wage growth. Then it's tied down to productivity. So there is a catch over there. It's not just Malaysia. I think in many countries for that matter. Even Australia, we're expecting another round of rate cuts to come into the picture. Then the bigger challenge is also like country like China. In actual fact, country like China, we are not too concerned about the 4 big banks, their NPLs. We know it's very well managed, very well managed. But it's the shadow banking. That's the tricky part. And you look at the private debt, that's another tricky part here. And you really look at numbers like, Prof, I think you should be looking at numbers like the Purchasing Managers Index. They tell you very nice stories which politicians don't know how to use it, at least for now. So because they don't know how to use it, so they can't rape that number. Otherwise, they'll rape that number off. Because those are real life numbers, they're all pointing downwards. Okay? So when you tell me that the Purchasing Managers Index of manufacturing and services are all coming down, then how can you get this kind of numbers, good numbers? So it's just a facade out there. I think we look at these kind of numbers very clearly. So generally speaking, in a nutshell, if you want to ask me any questions after this, you can. In a nutshell, is that it's going to be very challenging, not just 2019. I'm looking at 2020, 2021 also. It's going to be a tall order for us. Okay? It's not just Malaysia, but it's around the world. Already Singapore has already registered only a very low second quarter number. The Q-on-Q number is a negative number. That's the first indicator for us in this region. So potentially it could be Malaysia. The only good thing about Malaysia, we are trying to roll out some of the construction projects that we stopped. And because we were able to renegotiate with China well, and we were able to save a lot of money, things should be good. But the challenge here is also on the political side. Because of that domestic issue there, we are not seeing consumer spending picking up. Yeah. Okay. With that, thank you.
Just one question. When your outlook changed for the QE in US changed from rates going up to rates.
I think it's not political base. It's more of economic base. For a start, even the trade tension, though many people don't like Trump, I think what he's doing is right. Because logically, if you see this whole thing, if I'm doing business, say with you, you are persistently running on a trade deficit and I'm enjoying a huge profit. On the top of that, I'm riding on a quote-unquote devalued currency. So, it is actually unfair practice here. This is something that was not brought up today or yesterday. Even during the time of Obama, when he was the president, the first term itself, it was brought up to him. But he chose not to do anything at that point of time. So we can't do anything. Because no other person in the world can do anything apart from US. So 2 terms, we noticed China was actually practicing a lot of unfair trade styles, in particular over their currency. So what they were doing is that they were keeping the currency artificially cheap, where countries like Malaysia, we could not compete. Because you really look at it, a very easy way, no need to use REER. You just take the daily movement every day and you take the simple average out, you see where they stand, where the others stand. This was what was happening. So to the point that at one point what happened was, before this change of government, under the previous government, I remember Najib called me one day, I had to go and see him, and nothing to do with 1MDB, okay? So, or the SRC money, okay? So I'm clean, okay? Otherwise I'll be somewhere. Okay? And what happened is, we wanted to see the bilateral trade between Malaysia with China. When we looked at the bilateral trade, it was not favoring us. Okay? Absolutely not favoring us. Thereafter, when I traced back the whole trace of the flow of money, the moment it reaches Hong Kong to China mainland, you see the growth rate of the exports runs out 100% every month. So I said, that's where they inflate the invoice out there. So the So from the shadow bank, that's how they buy property, this and that, and whatever not. So that was what was happening for the last 10, 15 years. Okay? So eventually when this guy came and slammed all these tariffs, which is one way is good, but then he started hitting everybody. Because the US perception is, as long as I have a trade deficit with you, that means it's manipulation. Okay, so that I think became a bit too loose. But he should go into selective areas of things. And we hope that it just stops there and doesn't come here. When he says that we are manipulating on our currency, that was when I refuted, saying that we never manipulate currencies. Because we don't have that ammunition for a start. We don't have enough reserves to manipulate our own currency. Okay, so that's the tall order that we are facing today. So I think that part of it is good. Talking about this cutting of the interest rate is because sentiments are all coming down. So when the sentiments are coming down, yes, Trump wants a cheaper dollar. Trump actually wants the rates to go down because he does not want us. He's got 30% of his GDP is exports. 60% is all private consumption, and that is coming down. So logically, if you are the president, you'll do the same thing. So that is where the institution is coming in. And his inflation, he can't even hit his 2% target. So he's struggling on it, let alone Japan, let alone Europe. So they're all struggling on the 2% target. So this was when, recently when I met some of these ambassadors and also the IMF chief when she came down, I felt that the whole world should now revise their inflation target. No more to use 2%, bring it down lower to 1.5. Because it's all new low. Now we are talking about another new low if, say, there is an economic slowdown or recession next year or this year. So we're going to talk about a new low. So why are we harping on a 2% inflation target? There's no way Japan can hit the 2%. It's quite unlikely even for US to hit the 2%. So you might as well bring it down lower and work on a new norm, new low, and a new set of policies coming into the picture. So World Bank bought the idea, but IMF is only like 50-50 kind of thing. The second part of the whole thing is that for countries like Malaysia and all, not just Malaysia, anywhere, what I see to Prof just now. What I foresee is more of a nominal GDP recession. This happened few times in the past. Because when you do not have the kind of underlying inflationary pressure, nothing is moving up. So you need to ramp up that inflation side here. So it will be good if they have a war there in Middle East. Okay, it will be really good. At least we see the oil price going up, and Trump doesn't pump in his shale oil. Then at least you'll see some cost push pressure somewhere. Sometimes you need a cost side inflation if there is no demand side. I mean, sometimes it sounds cruel, but you need somewhere something, you see, to spur something up. So the other way is what we need now is to actually ramp up the nominal GDP. You can't do much to your real already. So the nominal can only come in if the consumer spending picks up. So this is where we are. So to your question, I don't think it's politics. It's definitely an economic business kind of way of thinking.